Hey everybody, welcome. This is Merrill Chandler, your host of the Fundability Universe. We're we're a little lower energy today. Working on recovering from a I don't know. I was told by a non-medical professional who is very accustomed to it. I might have food poisoning. I did not want to blow off our time together. So let's get through some very important updates that are happening out there. Number one, um, the, the Senate has actually gotten involved in the what do we call it? Have gotten involved in what would be classified as the turf war between credit card issuing banks and the Visa, MasterCard kind of oligopoly, the monopoly they have on what are called interchange fees. So Visa and MasterCard have this, as we talk about in my master course, aka the boot camp. They have dominated the amount of processing fees. Now, the majority of these fees, of course, go to the issuing banks, but it's not been really like a heavily negotiated contract to use Visa and MasterCard to collect dollars. Banks have had to do, have kind of had to, tuck their tail between their legs and do what Visa MasterCard has asked. So the Senate, so I don't know who Dick Durbin of Illinois and Roger Marshall introduced the Credit Card Competition Act of 2022, which required the largest Visa credit card issuing banks to add a second payment card routing option to cards to lower merchants' processing costs. That's awesome for us. Now, this comes in the light of what we've talked about earlier, that buy now, pay later, both credit lines and installment loan versions of the buy now, pay later have also come in and are raising the costs already, because the costs are set so high by Visa and MasterCard, 3 to 8% generally. So that every dime that when you run a Visa, a MasterCard, don't worry, American Express and Discover all have this high processing cost. Typically, American Express higher than most. Well, these exchange rates, that 3 to 8%, is gutting profits from every merchant who decides to use one of these credit card processors. So this basically forces competition to add. Visa, MasterCard will now have to compete with a second merchanting option for every credit card that they have. And this is actually great news. Great news for small businesses, great news for big corporations. Even Amazon will win on this, because whoever uses these credit card processing outfits have to pay these fees. So there will be really no additional positive effect to buyers, users of credit cards, but it will allow a more collaborative space to be built between the merchanting organizations, Visa, MasterCard, Discover, and American Express, as well as the banks. So that's great. That's great. There are some conditions there, but the conditions are, it's for the larger banks who are processing literally zillions and zillions of dollars through Visa, MasterCard. It doesn't necessarily affect yet credit unions or lower asset banks. All right, next, more and more. Here's a big. This does impact our current marketplace significantly. Their businesses are growing frustrated with the service at their banks. So small businesses, small mid-sized businesses have typically, and I've shared with this with different stories from my master course, and you can find that at www.fundabilitymastercourse.com. But that many banks, traditionally business banks or business divisions of banks, have ignored the small business borrower, unless because it's very expensive to do manual underwriting. Most businesses cannot be approved through automatic underwriting, that one-page credit card-like application that would approve $50,000 to $100,000 in a business line of credit or in a business loan. So bankers don't like spending that kind of time or energy with such a low volume. They have no problem helping somebody do a manual underwriting for $1 million plus size loan. But that 50 to 100,000, which is a game changer for small businesses across this country. And so a survey was done where 44% were trying. 44% of small businesses that recently moved banking was because they were being ignored by their business banking bankers. And so fascinating that we're in a position to understand why, based on our relationship with FICO, what FICO's told us about the priorities of business banks. And as we've shared in recent updates, FICO is helping their banker clients understand that fintech is killing them in the rate and term and accessibility to capital, because they are willing to do more automatic underwriting. And so right now, this small business banking survey is basically another nail in the coffin, showing that business banks have to change their policies, must add more value to, and serve their business community better, or we're gonna everybody's just migrating away from these traditional banks. So you heard it here first. We're going to see more and more movement away from these traditional banks because they're not addressing the needs of us regular old, Joe the plumber, right? And Mary the hairstylist. They want to expand or buy inventory, or all the things that we do in small business, and these smaller banks. The credit cards aren't necessarily the problem. It's the credit lines and business loans that would help us capitalize. So that's a big deal now. And like I said, another nail in that coffin. All right. And then finally, everybody was on Wells Fargo's ass about creating false accounts to help to meet marketing numbers so that they can get their bonuses, right? Remember how we talk about in the master course that the C-suite, the CEO, CFO, and the board of directors all make massive bonuses when they hit certain short-term targets, usually quarterly targets. And so to hit some of these targets, it's expanding their marketplace. Well, the Consumer Financial Protection Bureau, the CFPB, fines U.S. Bank $37 million for sham accounts. Banks' employees unlawfully accessed credit reports and personal customer data to open unauthorized checking, savings, and credit card accounts. They literally pulled credit reports and opened up accounts on behalf of their customers. So Wells Fargo is not alone, and U.S. Bank, which is, we call it the fifth tier one bank. If there's a bank is next to becoming a tier one bank of the top four, this would be the fifth one, and now they're just getting slammed. So the CFPB did the Wells Fargo. They basically refer to the Wells Fargo fake accounts in 2016 and 18, and the CEO insisted that the $500 billion asset bank did not impose sales quotas. So here we go. When sales meets, they're supposed to be, banks are supposed to be fiduciaries. A fiduciary responsibility means that the more powerful or influential in among the parties is supposed to take care of the interests of the less powerful in an agreement or a contract. And banks are typically have fiduciary responsibility to take care of their clients and look out for their best interests. And now they're engaging in getting checking accounts, savings accounts, and or credit card accounts on behalf of users. So no bueno. Now I got to say, a $37 million fine is nothing. In fact, it was multiple hundreds, thousands in fines from Wells Fargo, but it doesn't go through the scope of how many of these were open, just that they had found them and were being fined accordingly. So thank you for joining us today. This is the more chill Merrill Chandler, your guide to the fundability universe, and we will see you next Tuesday. Yes, next Tuesday I will be in Sarasota, Florida at my board of advisors meeting, but I will take some time out of those meetings to come back, visit with you, and hold our Funding Hackers. So for those of you who are listening, we're going to the Funding Hackers Q&A live with the more sedate Merrill Chandler, and we will see you guys on the inside.